Welcome to everybody, and thank you to our virtual audience out there for joining the first panel session of TheCityUK's 2020 National Conference. Now, we have a defining theme for the day, recovering. So this discussion is going to consider the megatrends accelerated by the pandemic, what they mean for our industry, and how we can respond to them. We've got a very distinguished collection of panelists, Omar Ali from Ernst & Young, Deborah Mattinson from BritainThinks, and Lord Willetts from the Resolution Foundation. And they'll give views from their own vantage points across industry, policy development, and public opinion. We've got quite a broad agenda this morning, so we're going to cover issues like business and the industry's response to the pandemic so far, behavior change, innovation, and the future of services, trends in the labour market and how this affects the future workforce, broader challenges for the UK as it moves towards economic recovery, and the industry's wider contribution to society. We're going to start off with some opening remarks from each of the speakers, and I'll introduce them in more detail before handing over to them. And then we'll have a long, I hope a long, question and answer session. I'm going to be asking questions, but in the usual way, you'll have the opportunity to submit questions virtually via Zoom for answering later in the session. So first up is Omar Ali. Now, for those of you who are frequent visitors to the TheCityUK, Omar Ali needs absolutely no introduction. He is the managing partner for UK Financial Services and EY, has just taken on responsibility for banking, insurance, and wealth and asset management across all Ernst & Young's 18 markets. So Omar, shall I turn it over to you for the first crack?
Yep, good morning, and thank you, Sir Adrian, and nice to see you and all the panelists this morning. I think Lord Willetts' bookcase is winning. I think Deborah and I have a bit of work to do on ours. So nice to see you all. You set out quite a broad agenda for this panel session, so perhaps let me just share a few reflections. It was clear that the events of 2020 required some immediate actions from all of us, from the country, society, and the industry, to ensure that we had adjusted to the pandemic. And I'd say that the FS and professional services sectors adjusted quickly and stood up to help the collective effort. And I hope in a way that the public can resonate with. I'm sure we'll come back when Deborah speaks on how the industry has responded and what the perception is. But before we do so, I wanted to take a step back, if I may, Sir Adrian. For me, the crisis is a unique opportunity for reflection on how we want to respond to some of the bigger forces impacting us as a society and as an industry, and adjust to the opportunities and risks that they may offer. And we've done a lot of work on global megatrends, the forces that drive them, the disruptions that we expect to see on the back of them. And 2020 has certainly highlighted for me that disruption doesn't just come from technological shift or business model shift. It can equally be driven by national elections, climate change, societal movements, or sadly, a pandemic. And for me, when I package all of this up, I package them into four key megatrends: technology, demographics, globalization, and the environment. And even before the pandemic, these disruptions from these four forces were accelerating. And let me highlight just a few of them. Maybe I'll start with a positive. There is a new energy, or it feels like there's a new energy behind tackling decarbonisation. I've heard people mention it all throughout the course of this morning. And of course, it's been helped, no least, by the election of Joe Biden and what is reportedly going to be some of his signature policies. Closer to home, we saw some amazing progress on this agenda just last week at the Global Horizon Summit. Secondly, and I think very positively, all firms are now thinking about their contribution to society, their purpose. And this means that we are all having to look at value differently. Our financial value, shareholder value, and productivity still really the most important metrics. And importantly, as we consider that question, we are starting to look at areas like inclusion and what businesses can do to help mend the social fabric. All very positive, I think. And for the financial services and professional services sector, I believe we've got a role to play in all of these. And I think we're going to be judged by how well we lead, enable, and change and deliver the change that society wants to see, and increasingly wants business to play a bigger part of. And there are, of course, then disruptions which are arguably more challenging, Sir Adrian. Technology and the massive leaps that we are now seeing as a consequence of 5G, AI, quantum computing, cloud, and edge computing. They're all presenting solutions probably to problems we didn't know that we had, but they also demand a different way of working, a different approach to risk, and different way of thinking about ethics, which also leads to I think, a compounding challenge, one of behavioral economics. How companies and others now measure, understand, and shape behavior is huge. And disinformation is becoming a major reputational threat for businesses, not least financial services companies. We saw all of this play out in the elections just now. The power of data is all pervasive, yet how we manage the good and the bad outcomes from it is still playing out. And then slightly more near term, and I had just heard the governor of the Bank of England speak. I mean, the economic conditions in which all of these macro forces are playing out are testing, to say the least. We're facing long-term low interest rates, maybe negative interest rates, unemployment and debt levels that we haven't seen for decades. And perhaps I should have finished on the positives, but without talking about the depression around the economy. But let me just end on a slightly more upbeat note, which is all of these disruptive trends will inevitably create more growth markets and new sectors for us to all play in, and teach us different ways of running our own businesses for the better of our employees, but also society. And a prime example of this was only last week when the Chancellor announced the launch of the first UK sovereign green bond. That's going to help finance projects, and I know we're still waiting for the list of what those will be, but they will undoubtedly tackle climate change, finance much needed infrastructure investment, and create green jobs across the country. For us in FS, that also helps to create, I hope, the UK at the centre of a green bond market for corporates and other institutions. So showing that there is a new market again, Sir Adrian, on the back of some disruption.
That's super, Omar. Thank you very much. That's a good way to get us all started. Let me move on to Deborah Mattinson, if I may. So Deborah is a founding partner of BritainThinks. I mean, she's well known for developing all sorts of innovative ways to bring decision makers closer to the stakeholders. In the past, she was pollster to Gordon Brown, both as Chancellor and then as Prime Minister. And she's one of the leading commentators now on public opinion in Britain. So Deborah, over to you.
Thank you very much. So yeah, I'm going to start on a slightly gloomy note and then end on a more positive one. I think that, the backdrop here is that it's quite hard to think about the industry and the megatrends in the industry without thinking about public opinion and where it is. And the backdrop is that the national mood is gloomier than it has ever been, than I've ever seen it in literally decades of measuring it. So 3/4 of us right now feel very pessimistic about the country. Almost half feel pessimistic about our own local area. And most of us feel a little bit more positive about our own personal circumstances, but 1/3 of us nonetheless feel pessimistic or very pessimistic about our own situation. So it's a striking and difficult time. We're worried, we're scared, we're even sad. We're sad about COVID, about the economy, about the divisions in society, and about politicians' ability to deal with all of these things too. And trust in that respect is at rock bottom. So COVID and the economy conflate when people think about who is going to pay for all of this. And 8 out of 10 of us have a sneaking feeling that it's going to be us that pick up the tab. But the crisis is a real inflection point. And for the public, what we're finding is that only 9% want us to go back to normal, whatever that means, when all of this is over. And just 6% say that they want the same kind of economy that we've had before. And I think the crisis is a sort of inflection point for the sectors that the TheCityUK is concerned with too. People have a new awareness of the crucial role, particularly that financial services play in their lives. So 1/3 of us say that we've been surprised by the support that has been given, things like mortgage holidays, business loans, overdraft support, lower insurance premiums. And the focus groups that we ran for the TheCityUK gave us lots and lots of really sort of powerful anecdotes about the personal experiences that people had. And the messaging work that we've done shows very clearly that there is a real opportunity, I think, for the industry at this point. And it's an opportunity that lies in three main areas. So the first of those is that rather than being seen as the problem, as the industry clearly was during the financial crisis, financial services are now have the potential to be seen as part of the solution. And 4 out of 10 agree that this is the case. Now, 4 out of 10 means there's some way to go. That's not perfect, but actually it's nonetheless, I think, given everything, quite a good result. The second point is demonstrating that the industry is genuinely trying to help. Again, it's not perfect probably, but 6 out of 10 of us agree that the industry is indeed trying to help. And as I say, they are very aware of some of the measures that are being taken. And then the third point, and this in a way is the big overarching point, given the backdrop of people's pessimism about the country, the third point is that the industry's efforts can really help the country to recover. And a really striking 3/4 of us agree with this. And I'll just end by leaving you with one quote that came from one of the focus groups. This was somebody in one of the Redwall constituencies, and I think it's quite powerful. He said, "The financial sector is now the backbone of this new Britain we are becoming, contributing more income and generating more jobs than any other sector. It really matters." So I think that's quite a positive note. So I'll end there.
Thank you very much, Deborah. I mean, that is from the gloom to the bright uplands, or at least the promise of the bright uplands. So let's move on to our last panelist, who's the Right Honourable David Willetts, who's the President of the Advisory Council and the Intergenerational Centre for the Resolution Foundation, and came to that role after a long and distinguished career in politics and public service, having been MP for 15 years, no, 20 years pretty much, and then Minister of Universities and Science, and previously having worked both in the Treasury and in the Number 10 Policy Unit. So David, over to you.
Well, thank you very much indeed, Adrian, and thanks for the opportunity to join this conference. I agree with the trends identified by Omar and Deborah. I'd just like to look at 3 of them, particularly through the prism of the virus crisis. There's first of all the question that Deborah touched on is, how is this all to be paid for? And at some point, not in the near future, but down the track, taxes are going to have to rise in the UK and probably in other countries as well. And the backdrop to this is, I think, a really important megatrend, namely that in Britain in the last 30 or 40 years, and also in the US, there's been a massive increase in the value of assets relative to GDP. We've gone from a country where wealth was 3 times GDP to one where wealth is 7 times GDP. And at the same time, the proportion of GDP collected in taxes on capital has not gone up at all. That is the background to episodes like last week's Office for Tax Simplification story. The Treasury will be looking, if there have to be tax increases, the Treasury will be looking at ways in which they can somehow tax capital in order to do so. And that's very relevant for the financial services industry. Although in theory, some people want to tax wealth, certainly the Treasury doctrine is it's hard to get at wealth when it's just sitting there being enjoyed. It's best taxed when money is actually moving. So although the economists don't like transaction taxes, you often find it's taxes that are prompted by a financial event that is the form in which taxes on property take. That is an issue that's not going to go away. My second comment is on the peculiar nature of the recession that has been brought on us by the virus. It's much more sectoral in its impact than previous recessions. And we all know the sectors that have been worst hit, retail, hospitality, leisure, sectors like that. And from our work at Resolution Foundation, in turn, we know that those are sectors that had unusually high proportions of workers who are either young, under 30, or old, over 60. So this is a recession that's had a heavy impact on some sectors and some particular generations. Now, the very lively debate now going on in the Treasury is how rapidly will they recover? What's the job market going to look like in a year or two? And for some sectors like leisure and hospitality, I think you can be quite optimistic. In fact, with all the optimistic news about the vaccine, it could be like the roaring 20s by next year, where I think a lot of us are looking forward to some parties.
Yeah.
It's not clear at all, however, that, for example, physical retail is ever going to come back. And there may be some other, and I think longer distance travel may well take some time to come back. That means there are particular problems facing younger people, and the agenda that I care about and written about in my book, The Pinch, how we help the younger generation, is going to be even more acute, because they're the worst victims of this, both in labour market and educational terms. Which leads on to the third trend. I'm not sure it quite constitutes a mega trend, but it's a very interesting little demographic trend. And like Omar, I'm very interested in demographics. In the first decade of this millennium, between roughly 2000 and 2010, the number of babies born in the UK per year went from under 700,000 to over 800,000. That means that we are now seeing a surge in the number of older children, which will rapidly become a surge in the number of teenagers and also young people, for example, trying to get a place at university. So this background of a raw deal for young people occurs at a time when there's quite a sharp increase in the number of them. And what we offer them, including the financial services we offer them, I think is going to be a very important issue. Thank you.
That was tremendous, and thanks to all three of you for some really interesting opening remarks. Now, I'll start off with some questions, but let me encourage everybody viewing this virtually to put in your questions on the Q&A facility on the screen. Omar, can I come to you first of all? Now, you touched on the impact of the pandemic on the economy, and in particular, the impact of long-term low interest rates and the levels of unemployment and debt on business balance sheets. What does this mean for financial services firms? And how do you think the industry can best support a return to growth?
Was that for me? Sorry.
No, I think that was to Omar.
Oh, sorry.
You're welcome to take it, Deborah. You're welcome.
I'm panicking slightly, actually.
Well, we've just heard from the governor, and my takeaway from listening to the governor was that economists definitely do not have an easy job right now, if ever they did. So forgive me as I kind of become a hostage to fortune here and share some economic forecasts of my own. Our latest EY Item Club economic forecast was predicated on an assumption that we would get a Brexit deal by the end of the year, and that more normalized economic conditions would return in 2021 with a gradual relaxation of the COVID-19 restrictions. None of this is guaranteed. So therefore, for us, some of the risks are to the downside, despite Lord Willetts' positive comments about the potential for a vaccine. And when we look at some of the headline figures, let me give you some of those and then perhaps get into what it means for FS. They are rather gloomy, regrettably. And despite a bounce back over the summer, our forecast is for a record negative 10% decline in GDP across 2020, with unemployment forecast to rise to nearly 8% by early next year in many of the areas that Lord Willetts just highlighted. Being the largest constituents of it. And within that, we're also forecasting that consumer spending will fall by 13%. 2021 is forecast to be better, but it will still have GDP and consumer spending miles away from where it would have been in the pre-pandemic forecast. Now, of course, in response to this, the government has done a huge amount, unprecedented levels of support. And we're seeing both the financial services industry and the regulator lean into this to put further support measures in place for customers, SMEs, and the like. And I think some of that is what's highlighting some of what people have been telling Deborah and what she highlighted a short moment ago. Now, bank lending and borrowing are just a couple of indicators of how much the world has changed over the last 6 months. Let me bring that to life for you. The latest numbers from Treasury show that they have supported £62 billion of lending from government schemes to date. And when you add that up to what the banks themselves have been doing, our forecast is that bank lending will be up 11% year on year. Put that in a slightly different way in terms of net borrowing. Net borrowing this year will be 5 times higher 5 times higher than the amount borrowed in 2019. And I guess the part of the challenge, and it goes back to some of the other panelists, is that at some point this will have to start to be repaid. And with many of these firms we're predicting won't start to repay until 2022 at the earliest. And on top of that, bank lending is still forecast to grow by maybe 5% next year. We are talking about an astronomical level of debt being pumped into the system. And Adrian, as you'll know, we've referred to that in other guises as unsustainable debt. Now, the banking sector and what FS has been doing is remarkable. They've been doing all of this whilst facing a multitude of challenges, long-term low interest rates, maybe negative, but unfortunately also increased write-offs on loans. Now, our forecast on that is that total write-offs will rise from 0.3% in 2019 to nearly 0.5% of all loans by 2022, as firms struggle to meet their repayments. And of course, the most recent lockdowns should only exacerbate this challenge. And you asked what financial services can do, and I guess for me, it's what they can continue to do. I think the industry has already done a lot. You know, you look at things like mortgage extension, loan repayment holidays for businesses, consumers. They facilitated a massive amount of government lending schemes into the economy. And as we did through the recapitalization group, they have the sector overall has contributed a lot of thinking to how we can create something more sustainable for SMEs in the future. Now, all of these measures combined with where the government has gone, I think deal with the short-term pressures, but the longer-term challenge is huge. How we in the sector, combined with government, help to provide better options to fund the recovery and to fund growth, I think will be the big question. How we ensure that businesses and consumers are treated fairly and equitably when they do struggle to repay. And I think there's some good things happening there. The Chancellor announced last week also the long-term asset fund. And I think the proposed changes around the listings regime and the UK funds regime will help. There is clearly good policy direction to support the recovery. But whether economists are right or wrong, it doesn't matter. I think what is critical is that the financial services sector continues to do its part to help the recovery, continues to be seen as part of the solution, which is clearly different to where we were. And I think Deborah's words are encouraging. And over the next few years, we need a healthy financial services sector to recover from this, and recover in a way that we can all look back on and say we did the right thing. I think FS has to be at the heart of it, and clearly we need to ensure that it retains its world-leading place in a post-Brexit Britain.
Oh, well, that's super. It's also a very good segue into the question I wanted to put to Deborah. I mean, you were quite encouraging, Deborah, in describing the situation of financial services. And relatively speaking, it seems to me we've come up in people's estimation. And we're coming through COVID better than we came through the world financial crisis 12 years ago. Now, if you look ahead, what do you think the sector needs to do to sustain this improved perception in the eyes of customers? And other threats out there we ought to be aware of?
Yes, is the answer. And I mean, I think just to be clear, whilst I'm very keen to be positive and optimistic, I think what the sector has in front of it is an opportunity. It's definitely not a done deal. And I think that, you know, the public there's an open door, there's a willingness to listen, and they want, in a way, they want the sector to succeed because they can see the connection between the sector and their own lives. They don't always make that connection, and so it's a very important moment. But what I would say is that the jury is sort of out, and public mood is very volatile. So there is absolutely no ground for complacency, and I think it's going to be incredibly important to keep pressing the right buttons. And there are, of course, you know, a lot of traps, a lot of threats, a lot of dangers in the road ahead. And you know, the public themselves, I think, identify some of those. They have, you know, the backdrop potentially of suspicion, believing that banks, for example, are ultimately going to be in it to make profit themselves rather than to support them. That's a corrective that still needs to be made. But also, I think as we get to the point where this is over and financial support is withdrawn, there are a lot of watch outs. What happens when it comes to the moment where some of those loans need to be recalled, and what will that look like? So I think that there is a huge amount to do, and to be vigilant as you move forward and to keep reassuring people. And I think in the end, one of the questions that we asked actually in the survey that we did for the City UK was, what are the things that the financial services sector needs to do to continue to rebuild trust? And interestingly, at the top of the list was all about COVID. So continuing to support people, continuing to support businesses, as they struggle and grapple with all the implications of the COVID crisis. But once you get beyond that answer, then actually it's sort of back to business as usual, and it highlights all the things that you've all been very well aware of for a long time. So continued support for the most financially vulnerable, paying fair taxes, top people's pay, supporting small businesses, rewarding ongoing loyalty of existing customers, all the things that have been there forever. So, yes, you've got COVID, but actually you've also got to deal with all of the things that you've also had to deal with. And in that sense, nothing changes.
David, let me come to you, because the Resolution Foundation has got a tremendous and deserved reputation as a commentator on the position of the underprivileged, the vulnerable, and the young in society. And so when you look at levelling up and building back better, I mean, there are two great straplines of the government. But from the perspective of the Resolution Foundation, what do you think they mean? What are you seeking for them to deliver? And how do you think financial services firms can help in this great endeavour?
Yeah, and I think some of what it means is fairly clear. Like, for example, infrastructure spend being much more evenly distributed. And for me, speaking as a member of the board of UKRI, the Research and Innovation Fund, there's some very powerful evidence that actually private R&D spend is more geographically spread than public R&D spend. There are some policy challenges there. I'd add a couple of other angles, particularly relevant for financial services. I think what for a lot of Tories lies behind this, people in the government, is provincial small town Britain. So, and the financial services industry is one of the main players that has contributed to the vitality, not just of London, but of, say, Leeds or Manchester. But it's the small towns that financial services don't reach. And if I can tell a story from my time as a constituency MP, for me, in a small town of Havant outside Portsmouth, it's the local builder who used to be able to turn up at the local bank and say, please, can I borrow $500,000 or $1 million to develop that little site where the derelict pub is that you guys know, and the council are desperate to see a block of flats there, who found the loss of power locally by people in financial services who could take that decision, but knew that for Persimmon to borrow 100 million in London was fine. So the sense of power drifting away from local people, of which I have to say, from my experience, financial services is an example towards the big metropolitan centres. I think that's a challenge. I think something else is education. These areas that have been left behind, the government wants to level up, are by and large areas with relatively low levels of education participation. And there's a very lively debate on this in government, and we're probably going to have a skills white paper from them in the next few weeks. There's one group to which I belong that says, well, one of the striking features of these places is how few people go to university. And we don't want to be in a world where 60% of people brought up in Kensington go to university and 20% of people in Hull go to university. So we've got to spread those opportunities more widely. The other view is they've taken a decision in Hull that university is not for them. So we've got to provide better alternatives to university for people in Hull. Now, they're not completely alternatives. So I think there will be investment in better vocational options for people who aren't going into university, plus I think continuing increase in participation. But again, this is relevant for the career and recruitment practices of companies in financial services, which as a minimum need to look beyond the Russell Group. And if every time you throw in the bin the application from the University of Wolverhampton or the University of Teesside and look at the application from all the classic prestigious universities, you are reinforcing some of the problems in those areas.
That's super. Thank you very much. One of the trends that I'm conscious of generally throughout financial services is the growth of the importance that people are attaching to ESG factors. And we've got a couple of questions coming through from the audience which focus on ESG. So there's one here from Rachel Underhill, who says, I was particularly interested in the comments around the burden on the younger generation of the pandemic. Should FS providers consider adding such a consideration to their plans alongside other ESG measures? And then there's another one here from Andrew Kale, which is how mainstream do you think ESG will become in the eyes of retail customers as they start taking their own personal financial decisions? I'd like to have a crack at that. It looks as though it's probably your territory, David. Would I have a start on that one?
Well, thank you. Yes, and I did write a book, The Pinch, about all this problem. And I think the two different questions about ESG are linked, because one of the things we do know about young people is their intense concerns about climate change and the environment. So yes, I hope financial service providers can do more. One issue, and I used to have this conversation with the governor when he was heading the FCA. One issue is the way in which regulation of financial services, such as mortgages, has developed. And the fact is the easy access to mortgages that boomers had when we was taking out our first loan have been replaced by a highly regulated system, which is essentially aimed at protecting the assets of older people, but I think has become now the regulation is so heavy-handed, it makes it harder for younger borrowers moving from job to job to get started on the housing ladder. And innovation and flexibility in providing products, even within the current stultifying framework of mortgage regulation, I think would be good. And the second thing absolutely is green issues, which are not going to go away, and where the more sophisticated measurement of carbon impact, the better. To be honest, it's quite scandalous how slack sometimes standards are. People should not just be able to say their product or service is green. I think there'll be increasing pressure on agreed rigorous standards for exactly how much carbon has been emitted in the course of producing it and maybe in the course of using it. An interest in these increasingly imaginative programs for tracking the entire supply chain back. Everything from these horror stories, of which there's another today about employment terms, but also exactly where did this wood come from? Can you be sure, can you really assure me that it's been responsibly grown? Exactly how much carbon dioxide was used getting this to my shop? So I think that type of challenge, where there is an opportunity for Britain to be a leader in carbon measurement standards and technologies.
Yeah, great.
I was going to turn to you, Omar, to touch on both decarbonisation in general and these climate-related disclosures that are now being mandated more widely.
Yeah.
What do you think this means for financial services firms in the medium term? The Chancellor talked a lot about green finance in his statement last week, so this is absolutely the subject of the day.
He did, and let me just echo David's comments as well, because I think transparency and consistency will be key, and that will obviously encourage, to Andrew Kale's insightful question as ever, the traction within retail, but the retail customer base. And I get kind of torn on this, because on the one hand, to Andrew's question about how to encourage or whether retail consumers are interested in this, on the one hand, I look at it and say, well, actually, you can see that they are by the volumes going into sustainable funds and how quickly they have been growing. On the other hand, you look at things like fast fashion and how that continues to grow and is being pumped into the Generation Zs and so on. So action and words are not often as aligned as perhaps they should be. But to your question on progress on climate change, I mean, I think last week was huge. You know, we saw the UK take big leaps going forward on this, with announcements from the Chancellor, from Alok Sharma, BEIS, the FCA, Bank of England, the FRC. In fact, if you didn't have a climate change update last week, you missed the party. And the commitments to transparency and consistency across the agenda and the coordinated timelines around disclosures, and in particular the underpinning from the regulators around climate change disclosures, I think are really, really important and telling. And with David, I think it has the opportunity for the UK at the centre of regimes around transparency and disclosures. For FS, this is clearly good news, Adrian, because as an industry, we can only start to really understand the risks and opportunities that sit in our loan books, investment portfolios, if there is transparency around it, and if there is consistency from all sectors in how they are reporting it. And only then at that point can investors, be they institutions or retail, can make the decisions about whether they're going to back these companies or not. And there was a whole range of less widely reported ideas also floated last week. And Mark Carney made it very clear that he was committed to developing a credible market for carbon offsetting. You know, we know that that's been slightly hit and miss in the past. And if you put disclosures at the heart of it, combine that with the electrification of everything, and there's widely reported that we're going to hear a speech from the Prime Minister setting out the UK's plans shortly, I think there's a real opportunity for the UK to be right at the centre of this.
Deborah, can I turn to you? Because, you know, I think climate change has been coming up in people's personal radar of issues to start being concerned about. And as Omar says, there's been a huge momentum injected into this over the last couple of weeks. In your polling, in your interaction with people all over the country, what do they think of climate change? How important an issue do they believe it is out there? I mean, for the Westminster Little Corridor, of course, it's been something that preoccupied us for many weeks and many months. But out there, what does it feel like?
Well, this is tricky because the truth is that it actually hasn't been coming up the agenda. Actually, if anything, it's gone down the agenda, particularly sort of in the light of COVID. And with certain sorts of voters, particularly those sort of very politically important red wall voters, you know, I did dozens of interviews when I was writing my book. I don't think one person ever mentioned climate change or the environment as something that they were concerned about. Now, that doesn't mean it's an important issue. And as I think David pointed out, that it's younger people who are very interested in this. I think there's a kind of balancing act. At the same time, whilst it's not top of the agenda now, I think that businesses will be judged incredibly harshly in years to come for not acting and not being seen to act. So I think it's very important. On the one hand, you have the crisis that needs to be dealt with now and everything that has to be done. But if in 10 years' time, looking back, you haven't done enough, I'm quite certain that this is an issue that will rise up the agenda, particularly as those young people become older and they're thinking about their children and their children's children. So unfortunately, I think it's one of those difficult ones where I think it needs to be done despite the fact that there isn't right now a huge amount of traction in public opinion.
Very good, thank you. There's a question here from Samantha Mitchell as a segue from Andrew Bailey's talk half an hour or so ago. She says that the overriding message she took from that talk was that it was investment, investment, investment. That was the key message. And she'd be interested in the panelists' thoughts on how you unlock the investment potential of savers. I mean, we've got the long-term asset fund that Omar referred to briefly earlier on. While at the other end of the spectrum, there's low financial resilience owing to the shifts to the gig economy and more insecure work. So that it's as always a complex position. And let me ask you, Omar, to start with your thoughts on that.
Yeah, I mean, it's a big question, and as you know, we spent months over the summer trying to come up with the right answers, and it still remains a big question. Look, I don't think we are just talking about unlocking investment. I think we're talking about how do you find the right levels of support to those businesses that will be sustainable, those businesses that are viable. And I think that is a very tricky decision, not only for financiers, but also for public policy. But if you take a step back and you compare the UK to other developed markets, let's look at the US or even Germany as an example, the systems that they have in place, the processes that they have in place to support small businesses are entirely different. Now, we had something here under your leadership a while back, Adrian, and with the likes of 3i. But if you look at what other countries have, they have development banks, infrastructure banks, and they have more developed equity markets that allow financing for smaller companies. So we're stuck in a bit of a bind here. We don't yet have the infrastructure to support moving away from debt-based, often mostly high street bank-based financing to something that is perhaps more equity, more long-term, more what I think Andrew Bailey refers to as productive finance. Having said which, you go back to where I started right at the beginning. One thing this crisis does allow us all to do is to reimagine how we want the future to be. And I think there's lots of amazing ideas out there about how we can create longer term financing instruments for businesses to help them recover from this. And our own work, highlighted that there will be hundreds of thousands of businesses who will need more productive, longer term financing to help them through this crisis. Being totally reliant on debt-based financing and having that stack the balance sheets is regrettably a recipe for not recovering as quickly as we would like.
David, would you like to comment? Because, the gig economy and lower paid jobs, how you find a way of advancing the fortunes and the careers of these people so that they can claim a bigger stake in society's success going forward. It's a huge question, but how can financial services firms contribute to that?
Yeah, and they are, look, these are people, and one of the problems, especially for young people, is they're in low paid sectors. They are, in the past, young people used to be in the exciting high paid sectors. They now tend to be in sectors with relatively low pay, and shifting them into areas such as green jobs, gig economy jobs, including help funding their training for that, which could include commercial funding, is really important. But I also, just on the city background, and look, you guys are the experts on the city, you personally, Adrian, in particular, but just one comment on all that. I do think the crisis has been very good for both the British Business Bank and Business Growth Fund. And the way in which, and I was in Bays, the British Business Bank was really Vince Cable's idea, but I was in Bays when we were all setting it up. It's just had its 5th anniversary, and it was treated with a degree of wariness by the Treasury when it was set up. It has now become the crucial vehicle for delivering a lot of the programs that Omar is talking about. And the Business Growth Fund, that was initially seen, I have to say, by the main banks as their kind of parking ticket for misbehavior during the financial crash, and they reluctantly put a bit of money in it, as a kind of heir to 3I's. The British Growth Fund, similarly, is now showing some healthy returns and showing there were indeed previously unidentified opportunities of growth companies, especially outside London and the southeast. So the message for CityUK is, first of all, these two institutions, I think, are now going to go from strength to strength. And there's another role which I think will become increasingly significant because of this strategic competition with China. And I'm a veteran of the Cameron Osborne opening up to China. I still think that's the better agenda. But anyway, it's not where the mood is at the moment. Look at the regulations announced in the last week on takeovers and overseas takeovers. We're going to be in a world where there are some quite exciting British technology companies where, to do a slight caricature of the position we've got into, the security services and other experts are so aware of their value that we will not allow the Chinese to buy them. But the Treasury and the city are so doubtful of their value that they've never invested in them. And this is a very peculiar position for the country to have got into. And I have these conversations with tech entrepreneurs who say, I've got the Singapore Sovereign Wealth Fund all over me. I have a Chinese beard every week, but I can't raise money in the city because there's nobody there who's comfortable with the technology I'm working in. And the increased strategic challenge from China, plus the rise of British Business Bank in the epidemic, means I think there's going to be more innovation, because we can't say we won't let the Chinese buy you, but we're not going to invest in you ourselves either. That would be hopeless.
That is a very good challenge to financial services generally, David. I'm afraid we're almost out of time. I've got quite a long list of questions, which I'm afraid we're not going to get time to go to. But I'm going to give you each a sort of 15-second, if I may, time to respond to this last question. because 15 seconds or 10 minutes is what it takes. And I'm afraid you've only got 15 seconds. So, and it's Andrew Kale again. What are your personal predictions on the future of the office, central business districts in the next few years? Back to normal or ghost towns? Now, as I say, you can take 10 minutes over it or 15 seconds. Please go for the 15 seconds. Omar, what about you?
Neither a ghost town or neither back to normal, Adrian. It will be reimagined, but I personally cannot wait to be out of my loft.
Deborah?
I agree with that. It will. I think they will change. It's a very dynamic situation, but yeah, I'm desperate to get out of my basement, which is where I am exactly the same. I think it'll end up being an interesting mix.
David, you obviously spend much more time in that room than the other two do, judging by the length of your bookcases. What about you?
Work from home and going to town for the party afterwards.
That is a great note on which to bring this to an end. So thank you, all of the speakers. We've had a tremendous glimpse into the different realms that you all occupy, and you entertained us and provoked us very well over the last 45 minutes. Thanks too to everybody in the audience. I'm sorry we didn't get through to all of the questions, but I hope that's a good taster for the rest of the conference coming up. So thank you all very much indeed.